Hello, Pro Traders Club members. Now we're going to take a peek inside foreign exchange flows. And what we're going to do is we're going to have a look at some of the primary instruments that move from one institution to another institution, and kind of how they work among one another to make and facilitate these transactions that are creating the enormous amount of monies that move from one entity to another. Uh, it is kind of a bit of a big picture look at the foreign exchange market and a bit of an inside look. And what it's going to do is it's going to give you a bit of a feel for um, uh, it'll give you something to relate to when you see your foreign exchange news feeds come up through your platform, and the news and information that will make comments on some of the transactions that are being placed and the volume that is moving from one entity to another, and it'll help you to understand where some of this volume is coming from. Every trade is a portrait of the trader who managed it. So when you make a trade, the manner in which you manage that trade, win, lose, or net zero, how you've managed that trade, and the decisions you've made in your equity management are a direct reflection of where you are as a trader. So if you're shooting from the hip, then you are a relatively shallow trader. But if you are managing it with prudence and discipline and discernment and patience, then you are much more developed as a trader and a person. We're going to have a look at the BIS survey, which is the Bank for International Settlements. And this survey, what they do is they come out with a triennial survey, and it is the only real accounting of foreign exchange flows on a global level. And what it is the Bank for International Settlements is effectively a central bank of central banks. And the member banks there's approximately 55 central banks and monetary authorities that are members of the BIS. And what they do is they take an accounting of foreign exchange flows through their specific entity and within their jurisdiction and under their umbrella. And what they do is they do an accounting of it, and they disclose it to the Bank for International Settlements on a triennial basis. And what they do is they then have an evaluation of the flows that move through the foreign exchange markets. What the Bank for International Settlements does, and this survey, it measures the turnover in the foreign exchange markets, and it measures spot transactions, outright forwards, swaps, and OTC interest rate derivatives are some of the primary instruments that are tracked through this survey. The foreign exchange flows are primarily executed by hedge funds and insurance companies, which are very, very substantial financial institutions. Hedge funds managed by CTAs, and some very, very large hedge funds, a lot of offshore hedge funds, and dealing internationally in international equity, foreign exchange, and derivative markets. First, we're going to look at spot transactions. Just going back to this slide, we're looking at spot transactions, outright forwards, swaps, and interest rate derivatives. So first, looking at a spot transaction, I realize I'm going to read this, and I know that you can read, and I'm going to read this off the slide. But it's a foreign exchange transaction in which one party promises to pay a specific amount to the other party on the same day or within 1 or 2 days. And that's what's called settlement. Now, through your retail trading platform, you make a transaction. So for example, you may sell US dollars and buy euros. Well, you've effectively bought euros, but the settlement isn't for, typically you may see a 2-day settlement. So what the broker does is he does what's called a rollover, and they roll over the position. Therefore, it prevents you from having to actually take delivery on the other currency. So you don't actually see the euros come into your account and to get deposited and rest in your account. In fact, they do a rollover, which pushes the settlement date back and effectively prevents you from having to realize the transaction and an acceptance of the currency which you bought in the transaction. The transaction, of course, requires a buyer and a seller, and it may require a credit guarantee from the bank. That's if you're trading spot, typically through bank. If you're trading interbank like a fund or so forth, or if you're trading your own account through a bank, it requires a considerable amount of money and will require a credit guarantee from a bank. Or, for example, let's say you are making a transaction, you're making a business transaction with another entity, and say the business transaction is for 5 or 10 or 20 or 50 or $100 million. Then what will happen is, if you're making a spot transaction and you send your $100 million to the other party and they're going to give you the equivalent in their currency, then it will require a credit guarantee from the dealing bank or from the counterparty's bank, because we need to know that that counterparty is good for the money. And they need to know that you are good for the money as well. And these transactions may or may not be delivered. For example, the transactions that you make through your dealing platform are not delivered on. Outright forwards. An outright forward is a future commitment whose terms are established now. It's a contract under which one side will buy and the other will sell a specific currency at a set price on a given future date. So let me give you an example. Let's say you're a Canadian business owner and you export largely to, let's say 80% of your consumer base is in the US, and they pay you in US dollars. Now, what happens if the US dollar loses a considerable amount of value to the Canadian dollar over a given period of time, let's say over a period of 6, 8, 12 months? And you have anticipated or budgeted for that revenues to come into your company. Now, you have to, where is the differential in the revenues going to be offset? Because if the Canadian dollar gains by 20% against the US dollar, you've now lost a considerable amount of revenues and your margins have now become very, very tight. So what will happen is you can hedge against any major currency fluctuations by buying an outright forward contract. Therefore, when you exchange monies with the bank, or exchange your revenues, your US dollar income with the bank, you've already agreed on a specific price to be realized at a certain date. Therefore, you can take your US dollars, and it's a hedge of sorts. So you take your US dollars, convert them into Canadian dollars at the price that you had previously set when the outright forward was purchased. An outright forward rate is comprised of the spot rate, so the current spot rate, and the forward margin. And some of these instruments that I'm laying out here, I'm just giving you a basic overview. And what you can do, you can simply do a Google search, go to University of Google and do a search, and you can certainly find out a lot more details about these instruments. A currency swap. A swap that involves the exchange of principal and interest, or it's an interest-bearing instrument in one currency for the same in another currency. And these swaps can become very, very complicated. And the parties may exchange principal amounts at maturity, and the price is influenced by the yield on the instrument, and on both, it's the yield on both currency and the spot rate. Okay, so what it is you may have two large corporate entities in separate regions that deal in separate currencies, and they may have business objectives that require a swap with another larger entity that may have a different type of objective. And what they do is they create this swap that is supposedly beneficial to both parties. However, there is risk. There is risk in the foreign exchange fluctuation. But these swaps they can be very, very complicated instruments that actually can be created unique to the scenario, and effectively they're influenced by the spot rate and the yield on both currencies. OTC interest rate derivatives, and these are made up of primarily commercial and investment banks. And what they do is they create interest-bearing derivative products to trade with one another. And again, it's one of these creation of products in order to suit their the needs of their business. Just to summarize, the 2004 Bank for International Settlements survey, the average daily FX turnover based on this 2004 survey was $1.88 trillion. It's a 57% increase since 2001, a very generous increase in the volume in foreign exchange plays with this whole globalization coming into effect, and there's just been just a gross amount of increase in foreign exchange transactions and international business, as well as movement of funds for investment purposes as well. 50% are forwards and swaps, and that's why it's important for you to understand on a basic level forwards and swaps, because you will see these flows moving through. You'll see the news feeds and so forth and the dealing of these instruments, and it will give you a feel for the volume that's being generated at that time that these instruments are being transacted through the foreign exchange market. 33% are spot transactions, and less than 10% are actually delivered. The US dollar is involved in 89% of trades, almost $1.7 trillion daily. Now, what does that mean to you? The reason why this is important is that if you're trading the US dollar cross, base or cross currency against any other currency, then you can expect larger volumes within that foreign exchange cross. So the largest amount of volume is being dealt in US dollars. In 2004, the Bank for International Settlements survey concluded that on a daily basis, the euro-US dollar traded the largest volume, $501 billion, 28% of the volume. Dollar-yen traded $296 billion, 17%. British pound, $245 billion, or 11%. So you can see here the major currencies are US dollar, base or crossed, all the way down to dollar Canada, and then we get into, you see here, the Japanese yen, and as we saw earlier, the Japanese yen has the second largest amount of volume, and then we see our yen cross down here with euro and euro pound. Now, a couple things I want to point out. 2004 survey, and in 2004, what was happening to precious metals? We know that the Australian dollar is a commodity currency and very much driven by commodity prices, and the Swiss franc, a gold-based currency. However, the 80% of their trade is done with the Eurozone. And again, the Canadian dollar, which is also a commodity currency, and there's really been a very large amount of flows this year. 2006 and 2007 will be also a considerable amount of flows in a Canadian dollar as a result of oil and precious metals and so forth. But that's a story for the fundamental section, which we will just touch on in this course. And there's a completely separate course on fundamentals where we can learn about all of these things. Twin U.S. deficits. We're just going to have a quick look at this now. The trade deficit, January 2006 was $68.5 billion. And in 2005, the goods and services trade balance deficit set a new record of $725.8 billion, and now in 2006 we are on pace to exceed that deficit. The current account equals trade balance plus money flows. What happened in 2002? The United States goes to war in the carry trade. The Fed opens the floodgates on money supply as interest rates move lower and borrowing increases. So we saw a decline in interest rates, which opens the door for borrowing. So more people borrow money and they spend it into the economy. They buy houses and cars and vacations and so forth and spend it into the economy. And the Fed effectively opened the floodgates on the money supply. Now the decline in interest rates sets up what's called a carry trade against countries with a higher interest rate. Primarily, those involved in the transactions are speculators and investment, move out of low interest bearing currencies and move their monies into higher bearing currencies. And we will talk about that in our next section.